Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. My apologies for some of the labels appearing in light green on my daily chart. My charting system occasionally decides to throw a tantrum, and this is one of those occasions. Late last year, a few bullish patterns started to emerge that eventually led to a move upwards towards the combined resistance in mid-December last year, made up from the November 2014 high at 201.35 and the 50% Fibonacci line of the February 2022 to January 2023 move at 201.70. Plus, I suppose you could also throw in the declining neckline currently at 198.95 of the April to May 2022 reverse head and shoulders pattern. Between them all, the market's rise was halted and turned back down through the imperfect and now broken bull channel, with the market eventually stopping down at the combined congestion around the 50% Fibonacci line of the May 2019 to February 2022 move at 174 and the August 2021 low at 174.5. All this was done in the middle of January, done by the middle of January. Since then, prices started moving sideways within a wide 177 even to 195 even area range until the start of April. During that time, the market had been fed ammunition from the important 50% Fibonacci line of the June 2020 to February 2022 move at 177.45 and the then nearby rising medium moving average. That's currently at 192.55. This moving average tempered the bearishness and then supported the move up to break higher through the neckline, through the 50% Fibonacci line at 201.70 and the April 2023 high at 204.90, up through the October 2022 high at 216.25, until 2 weeks ago prices peaked up just over the November 2011 high at 243.40. This move up happened so quickly, I didn't have time to set out topside targets. Well, so what now? Well, 2 weeks ago I took a look at the longer term charts here, and this is what I saw, and I quote: "The key move here was over the 50% Fibonacci line of the 2011 to 2019 move at 198.30. This has seemingly validated the action since September 2022 to date as a possible double bottom Adam and Eve type. Thus, potential targets for such a pattern topside would be a primary target X1 in the 235 area with a secondary harder to reach target X2 up in the 251.60 area. These are early dates, but that is what it is looking like right now." End of quote. Well, prices reached the primary target X1 in the 235 area late 2 weeks ago, exceeding them even. However, target X2 up in the 251.60 area is still live and also still above the market. This brings me to the pattern made on Thursday and Friday 2 weeks ago at the top of the recent market. Between the 2 days, they made a homing pigeon pattern type. It is not a clear homing pigeon pattern, but as it should actually be in a downtrend if it was, rather than as a top, hence the use of the word type with the pattern name. Now, traditionally, such patterns are seen as a bullish reversal. However, in reality, close to 6 out of 10 such patterns act as a bearish continuation pattern. Thus, last week, I said, and I quote, "It'll be interesting to see whether the market will follow tradition or the data. So far this week it is favoring the data." End of quote. Well, prices early last week did favor the data and headed lower, but then ran into congestion at 220.90, and the market has bounced higher in the middle of last week, though not far enough to create any mischief, as we are back again not too far away from the supports in the 220.90 area, though seemingly reluctant in chasing it lower so far. London cocoa. London coffee it should be, not cocoa. London coffee. During the process of the market breaking higher from back in December last year, prices started to stabilize for a while, right on the 50% projected Fibonacci line at 30.84. Although this 50% projected Fibonacci support did not last, it did start a process of stabilization that ended up with a late January 2023 to early March 2024 bullish halfway hesitation pattern between roughly the lesser Fibonacci congestion at 30.16 to 30.18, that's 1.6 and 1.8, up to the January 2024 high at 32.61. As all this was happening 9 weeks ago, we had the short medium moving average, currently at 34.93, enter the frame from below and turn prices even higher. In the process of making this halfway hesitation, the late January to early March action also became a small bear channel, come declining expanding wedge pattern. 8 weeks ago, prices shot up through the upper bear channel line, stabilizing again over it this time, and then the market, taking its own sweet time, started to exploit the upside. As I said 5 weeks ago, and I quote, "It nevertheless still lays out all sorts of possibilities topside." Thus, if we look at the bear channel as a bullish halfway hesitation, then we need to look at 2 points from the start, from where to start measuring it from. The first is the January low at 27.44, and the second is from the mid-December 2023 start of the rally in the 25.20 area. Thus, for the first pattern, we would have a potential target X in the 34.80 area, whilst from the second origin, you could see up as far as a potential target X1 in the 3700 area, well up and off my daily chart. And that's the end of the quote. A few days after my commentary, target X at 34.80 was reached, and 4 weeks ago, the harder to reach target X1 was also achieved. All this action allowed me to draw a new pattern, the bright red, late November 2023 to late February 2024 bullish Andrews pitchfork. The market seemed to fit well within this pitchfork, but 2 weeks ago, prices shot up and away from the upper time, currently 41.55. Though not as far as the 100% projected Fibonacci line at 43.09, before pulling back to sit on top of the upper time. I said last week, and I quote, "The market doesn't seem satisfied as yet with going down under the bright red upper time this time and back into the bullish Andrews pitchfork. However, I will continue to pay close attention to it. In essence, it is not a question of whether the market is bullish or bearish, but instead it's a question of just how bullish this market is willing to be right now." End of quote. This is still actually an open question, as the market is slowly getting squished between the 100% projected Fibonacci line overhead at 43.09 and the rising bright red upper time below. Something will have to give, and soon, within the next 2 weeks, as by then the rising red upper time will reach the 100% projected Fibonacci line. It is this proximity that is sowing the first seeds of doubt about this market being bullish in the first place. I'm not as confident on the bullish incentive now as I was last week, but we shall see. And then there is the final kicker. Beware of any false breaks in either direction.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.